The market's telling us that kind of level of oil demand not going to hold up. Do you agree? Is it sustainable?
So, as you said, last year, global oil demand grew by 1.4 million barrels a day. That's well ahead of sort of normal growth. The US growth last year, 500,000 barrels a day. That's the strongest we've seen for over 10 years. And the story there wasn't gasoline being put into cars or into buildings. It was a story of sort of, for ethane, a particular type of product which is used in petrochemical sector. So it's oil as a feedstock into the petrochemical sector, which was driving that strength last year. Looking at this year, we are clearly seeing a loss of economic momentum. Global economic growth this year looks like it will be slower. The IMF are suggesting sort of perhaps in the region of about half a percentage point slower than what we saw last year, and that will weigh on oil demand growth.
And talk about the distinction for petrochem, because that's going to be a very China-U.S. story, which in light of the trade war is going to be very interesting too, right? Because China's going to be short, we're going to be long petrochem. So can you walk me through what you notice about that?
Petrochemical production here in the US, some of it was absorbed domestically, but a large part of it was also exported to Asia. So this is just part of these interconnections around the world. And if we start seeing these trade wars, this is why I think so many people are nervous about these trade wars, is it does have the impacts reverberate around the global economy.
And sort of just to talk about why we're able to produce so much petrochems, it's also because we produced so much oil. This is an amazing bar chart. So the orange is U.S. oil production, and you can see it for sort of the average over the last 10 years versus 2016, 17, 18. That is an unbelievable amount that the U.S. produced.
Unbelievable last year. So the U.S. accounted for almost the entire world production, increase in world production of oil last year. U.S. oil production grew by over 2 million barrels a day. And much of that coming from U.S. tight oil. This is the shale revolution. And the growth in U.S. oil production last year was the largest ever seen annual increase by any country ever in the world. And add to that, likewise also for natural gas. So the U.S. achieved a remarkable first last year, the largest ever increases in both oil production and gas production. The shale revolution is alive and kicking.
Alive and kicking, but can it be sustained? Not just the level of production, but also the growth level. I mean, do the geophysics really support that kind of growth continuing?
I think the truthful answer is no one really knows. I think most people's expectations is it can support, the underlying reserves can support that type of growth over the near term. The issues over the near term, which I think are more likely to constrain the size of growth, is one, it's just the infrastructure, the takeaway capacity. Is there enough pipelines to get that oil out? And secondly, finance and the availability of finance. Are people willing to carry on supporting and financing this strong growth, or will investors demand greater returns, less growth, more return?
The answer is yes to your latter one. They are demanding more returns. So if this was the oil price 3 years ago, we'd all be talking about bank redetermination. They're going to cut the loans. The really high leverage companies are going to be totally out to water. But now we're talking about how Chevron and Exxon, they don't care if the price of oil is going to be 50. They want the short cycle play. They don't care if it's 70 or 50. They can keep on pumping and putting money into shale regardless of that short-term fluctuation.
So we had some interesting analysis in the report on this, where you would expect there to be increasing concentration of US tight oil production as sort of big oil moves in. You do not see that in the data yet. We have some analysis looking at the production accounted for by the top 10 firms there. That level of that ratio has declined every year for the last 10 years. And so that level of concentration you would expect to see, you don't yet see in the data.
The other part goes to sort of the broader takeaway. When you take a look at energy consumption versus what we see with carbon emissions, if all the countries are some countries trying to go to the Paris Climate Accords, where are we in reaching those kind of goals? Are we using less coal? Are we using less oil? Are we using more renewables? How do you see it?
So the data for 2018, which the Statistical Review reports on, is a bit of a wake-up call in terms of that transition. At a time when society is growing increasingly aware of the dangers of climate change, demanding more action, the growth of carbon emissions and global carbon emissions from energy use last year was at the highest rate for years. So rather than slowing, carbon emissions were accelerating last year. And so there's a growing mismatch between sort of those hopes for action on climate change and the stark reality where the data is moving in the opposite direction.
So the thing that jumped out at me in that chart was coal. I mean, coal is really increasing, and we've heard so many stories about people in China and the United States going away from coal to generate electricity. Where's all that new coal consumption coming from?
So it's really important. It is very largely in China and India into their power sector. So the story here is massive, rapid growth in renewables in those countries. So in China and India last year, renewable energy grew in each of those countries by over 25%. Over 25%. So massive growth, but great increases in power demand was outstripped that. So even though you had strong growth in renewables, it wasn't enough to meet all the demand for electricity. And so you saw other things being dragged in. And in those countries, the fuel which balances the system is coal. So really rapid growth in renewables, but coal still being sucked into the system to balance the system. And so what we saw last year was coal consumption globally rise for the second consecutive year after 3 previous years of which is declining. So many people had thought we'd seen the peak in global coal consumption. That peak now looks less certain.
So let's rework the framework and say, okay, how fast would renewable energy have to grow to supplant coal?
I think the honest answer is unbelievably fast or impossibly fast. And so the message, we did some analysis in the report, and the punchline message from that is rapid growth in renewables is absolutely essential, but it's not going to be sufficient. As the world moves to electrification, that process of electrification only makes sense if it goes hand in hand with decarbonising the power system. Renewables has a central role to play in that, but it won't be sufficient on its own. So we need other technologies. Widespread coal to gas switching, so using natural gas rather than coal, using carbon capture, use and storage, which is a way which you can use gas without generating carbon emissions. We will need many fuels and many technologies for many years to achieve this. Renewables essentially an essential part of it, but not sufficient on their own.
What's going to drive that? Is that China, I mean, as a government matter, going to drive that?
I think throughout the world, we need government policies. China is making huge gains here. So China is massive growth in renewable energy. The other really interesting thing about China is huge growth in nuclear power. So China accounted for around 3/4 of the growth in nuclear power generation last year. So they're growing almost every other fuel they possibly can to reduce their reliance on coal. But still, their demand for coal in the power sector rose last year.